So you think mortgage rates are set by the Federal Reserve? Think again. The real power lies within the 10-year Treasury. It's the invisible force that is controlling your monthly payments, your dream home, and even the entire housing market. Stay with me because what I would like to reveal is how it works, why it works, and what most people are getting completely wrong. Okay, so what I want to do is try to break this down pretty simply so anybody with any background can understand. What I'd like to start out with is, what is the 10-year Treasury? We'll talk about mortgage-backed securities as well and how they all tie together. So the 10-year Treasury is like a loan that you would give to the US government. So what you would do is you would lend them money for 10 years, hence the 10-year Treasury, and they promise to pay you back with interest along the way. So the kicker here though is that the interest they pay, or the yield, is constantly changing based on demand. So the more demand, the lower the yield is, and you guessed it, the higher the demand, the bigger the yield will be. So why is the 10-year Treasury key, and why is it more related to the housing market than the Federal Reserve? So why it matters to you: the 10-year Treasury acts as a benchmark for all long-term borrowing in the economy, including mortgage rates. Most people only keep their home for 7 to 10 years before either selling or refinancing out. So that's why most lenders use the 10-year Treasury as the guide for setting our mortgage rates. So there is a 1-year Treasury, 10-year Treasury, and the 30-year Treasury. And that's the 10 year as a benchmark because most people are either selling or refinancing out in that 7 to 10 year mark. Okay, we've talked a little bit about the 10-year Treasury. Let's talk about what are mortgage-backed securities. I'm sure you may have heard the term, but to make sure we're all on the same page for the sake of the video, and to make sure we've got a good understanding of it, I'll explain a little bit what a mortgage-backed security is. So when you get a mortgage for your home, it doesn't just sit with your bank. It gets bundled up with thousands of others and sold as something what is called a mortgage-backed security, or MBS for short. You can think of these as investments for big, huge players, if you will, like hedge funds and pension funds. Here are the catches though. The MBS have to compete with the 10-year Treasury for investors' money. The key point here is going to be when the Treasury yields rise, the MBS yields have to rise too. And when the MBS yields rise, so do your mortgage rates. Bottom line here, it's all about keeping the investors happy. So the MBS and the Treasury are competing for the same pool of investors' money. So here's the myth most people believe: that the Federal Reserve directly controls mortgage rates. So the truth, the Fed sets short-term rates like the ones banks charge each other. That's pretty much it. Think of the Fed as short-term. The 10-year Treasury, on the other hand, is set by the market. So very simply, supply and demand from investors. So when the Fed raises the rate, it does influence the economy, but the Treasury yield reflects the long-term expectations about inflation and growth. Okay, so why are mortgage rates still so high right now? What we're seeing is that the Treasury yields are still rising, and that's because investors expect higher inflation and tighter Fed policies, which is continuing to push the mortgage rates up and making it more difficult to buy a home. So good news is though, is when we do start to see the Treasury yields fall, the mortgage rates, generally speaking, will fall with that. So again, to kind of recap this, the mortgage-backed securities and the Treasury are both competing for the same investors' pool of money. The 10-year Treasury is a safer spot for investors to park their money because as of now, the US government has never defaulted on a loan. So as an investor, it's a pretty safe bet to put your money with the 10-year Treasury with an almost 100% assurance that you're going to get your money back over time. Whereas the mortgage-backed securities, the MBS, they are still a pretty safe bet, but there is a risk of default because it is reliant on homeowners to pay back their loan. Most homeowners do pay back their loan, but as we did see in the 2008-2009 financial meltdown, there were huge defaults across the board and investors lost big. So that's why you'll see that the mortgage-backed securities is typically 1 to 2 points higher than the 10-year Treasury, and that's because investors demand a risk premium. So if they're going to put their money in a riskier spot, they want to get paid out more. So that's why if you see the 10-year Treasury at a, say, 5%, typically you'll see the MBS or mortgage-backed securities at a 6 to 7%, and that's because the investor is expecting to get paid more for the extra risk that they're taking. Okay, so the next time someone says mortgage rates are high because of the Fed, you will know the truth and you will know it is truly all about the 10-year Treasury. So watch its yield and you will have a better sense of where mortgage rates are heading. They're going up, down, they staying flat. Either way, you'll have a really good idea of what's happening in the market. And just remember, the 10-year Treasury is what's tied most closely to mortgage rates. The Federal Reserve does have a slight influence over it, but it's more for short-term loans. So when you are thinking mortgage rates, think 10-year Treasury, and you'll be in a much better position to know what's going on. Okay, so now that you know the truth about the 10-year Treasury, mortgage rates, mortgage-backed securities, and how the Federal Reserve doesn't play as a big a role as you thought with the linkage to mortgage rates, what are your next steps? Are you planning to buy a home? Maybe you're thinking about refinancing or investing in real estate. Whatever it is, make sure that you keep an eye on this hidden driver of the housing market. It's going to help you out, make you a little bit more sophisticated, and maybe make a little bit better buying move. So if you did find this video helpful, please remember to like and subscribe. And more importantly, if you think this video could help someone, please share it with them, share the wealth of knowledge. And I know this is a pretty complex, robust subject that we compacted into a very short little video. If you'd like me to go into more detail or a little bit deeper dive on it, please let me know in the comments below. Or if there's other just real estate topics that you guys want more information about, let us know. We're happy to help any way we can. We appreciate you. Thank you for sticking with us, and we look forward to seeing you in next week's video.